Hello everybody, a very warm welcome to SD Capital's official YouTube channel. Today's session we are going to talk through some of the questions which has come to our mailbox mail.sdcapital@gmail.com. We do believe that going through these question answers will help many of our YouTube channel viewers to understand some basic concepts around equity investment. After the question answer session, there will be a long-term strategy discussion. So if you are in the equity market for longer term, what should be your strategy? We will actually go through that. But before these two particular topics, one clarification I would like to provide here, because we are getting so many questions around it. Existing portfolio management service. What is it? What value we are delivering and all that. So firstly, this is for people who want to streamline their existing equity investment portfolio. Many a times, people who have bought stocks of different companies over the months or years end up being confused whether to hold on to a certain stock or whether to sell it and close the positions. And it is very key. It is actually very important to make that choice. And I'll go through two instances which will probably help you understand why that is so key. So we provide that service for a minimum fee. And if you want that, please feel free to contact us. Our website also have all the details. You can contact us via our website, via our Facebook page inbox. You can drop a note to mail.sdcapital@gmail.com, whatever way works for you. So why it is so key to make that choice? Let's take two instances. One, you have bought some stocks and now the current market price is higher than your average buy price. So you are in profit. The question is, should you hold on to that stock for 6 months, 1 year or 2 year time? Will it go up further and will it generate healthy return for you? Or it has kind of peaked and now it is time to exit? That is $1 million question, because if it has peaked and you are just holding on to it, literally you are waiving your chance of generating better return via an alternate investment. Similarly, say you have invested in another stock and now the current market price is lower than your average buy price. So if the position is in red. Now the question is, will the stock price go up in future? Will it turn into green? Or it is only a downward journey from here and it is better to sell the stock and recover whatever amount you can and find an alternate investment for it, buy some different stock, invest in through a different vehicle altogether. So whatever be the case, but if you hold on to that position, it may very well be the case 6 months down the line you lose more money. So these are the choices to be made, and these are very key. And existing portfolio management service we offer actually help you understand, may help you make that particular choice. So any questions, please feel free to reach out. Now, the questions we are going to discuss today. The first question, someone has emailed us. I bought 500 stocks of Yes Bank at on 16th of March 2020. The price was 28.50. Current market price is below rupees 14. Should I buy some more stocks and improve my average buy price? In our world, there is a saying, do not try to catch a falling knife. This is a classic example of that. Yes Bank is in a bad state of situation. The management decisions has gone wrong. The capital adequacy situation is precarious and it has entered into that falling knife state for a long time now. In March, it was already in that falling knife state. So you probably thought that it is a good deal to get Yes Bank stocks at rupees 28.50, 28.50, but it is not, because it is going down consistently and it is going to go down further. So SD Capital strongly advises it is time to close the position, recoup whatever money you can, and invest that money into different stocks which has a good upside potential. And this is a concept which doesn't only apply to Yes Bank, it applies to many other stocks. Hence, please be careful. Cheap doesn't mean good deal always. Next question. I have invested in nationalized banks in 2017-2018. Right now, my portfolio is in red. Should I stay invested or should I exit? Nationalized banks, except for State Bank of India, SBI, SD Capital doesn't think that other nationalized banks like Allahabad Bank, Punjab National Bank, and all other banks, we do not think they are on a strong growth path. They have huge NPAs, non-performing assets, on their balance sheet. And by the way, non-performing asset is something like they have extended loan and they are not able to get that back. We all know the cases, Nirav Modi, Vijay Mallya, Mehul Choksey, all these people. So all these nationalized banks have extended loan to people like them, and now it's struggling to recover the money. There are complex ways to recover money, but that is complex and time taking. So we don't think, except for SBI, it makes sense to stay invested in such a nationalized bank. Again, we would advise that if you have invested, it is time to exit. Whatever loss you have to book, please go ahead and book. But that will actually help you cut your losses. If you hold on to these positions for longer, your losses may be higher. In fact, we believe losses will be higher. So it's better to exit. Third question. I want to invest in stock market. Where should I open my Demat account? I'm worried about my safety. There are many broker houses, there are banks which help you have a Demat account. They offer Demat account service, and all of them are listed with SEBI. So there is a minimum possible risk of opening a Demat account with a bank or a broker house and they cheat on you. It's very remote chance, very remote chance. But if one thing you just need to be careful about, if you are going to trade for the shorter term, if you are in for swing trading or intraday or something similar, then probably it's wise to make a note of brokerage fees, because when the trading volume is high, you are making frequent transactions, then it is very key to consider the brokerage amount. But if you are really investor and if you are here for long-term growth, then brokerage fee hardly matters. So it's all about your convenience. Number four, you discussed about short-term trading strategies and swing trading strategies on your channel. Do you recommend stocks for that? We don't. SD Capital recommend stocks for long-term investment. So all the free stock recommendations we provide on our channel ideally is for long-term. But sometimes if you follow the market judiciously, you may be able to book some profit in near future when you build your position into these stocks. Please be careful, because the stop loss price, the target sell price, all those details we only share with our clients. But as we have shown on our channel repeatedly in past, the free stock recommendations we provide, they are really good. So if it works for your portfolio, please feel free to build your position in those stocks, and you will be able to book profit. Fifth question. I want to invest rupees 30,000 for 10 years. I want to also invest roughly 5,000 to 7,000 rupees per year. Which stocks should I invest in for maximum return? The straightforward answer is if you are in here for the longer term, 10 years. So your plan is to invest 30,000 upfront and then 5 to 7, let's take 6K. So for 10 years, 6K into 10, that is 60K plus 30,000, 90,000 rupees you are going to invest in the equity market over a period of 10 years. We will strongly suggest you play by the nifty blue chip stocks. That is the short possible answer. And we discuss this question at the end because this actually helps us go into our actual topic of discussion today, the long-term strategy. If you want to invest in the equity market for long term, what are the things you need to be careful about? First thing is, if you are here for the long term, then you need to make sure that you don't give in to temptations. Mr. Buffett says that stock market is a mechanism which transfer wealth from impatient to patient. So attitude wise, you have to be very careful. If you are here for the long term, be patient, stay with the stocks which grows steadily. If you want to make 50%, if you want to generate 50% return, there are stocks available which will help you generate 50% return on 1 year. But please make a note that if a particular stock goes up by 50% in 1 year, there is every chance next year it will go down by 70% because those are highly volatile stocks. So if you are here for the long term, look out for the steadily growing stocks. Do not give into the temptations of making quick money because that will not help. Remember one thing, if you build a hut and there is a severe storm, there is a high chance that the hut will go away. It will take very short time to build a hut. But if you put the effort and time and build a concrete building, then it will be able to stand in a storm. So thereby, quick and easy doesn't work when there is a crisis. For example, there was coronavirus situation in March, and if you look at the stock market, there were stocks which were badly battered, badly in the sense really badly, and there were stocks which was battered somewhat, but they recovered pretty soon. And that's why it is very important to stick to stocks which are really good fundamentally, which are steadily growing. The next thing you need to be careful about while building the long term, while you are in this market for a longer term, that is a good diversification. We emphasized it in past, we are re-emphasizing it, that if you are here for the longer term, please do not put all your eggs in the same basket. You have to do a meaningful diversification. If you are doing it on your own, then as we keep on repeating, for even a beginner, it is possible to start the journey with 8 to 10 months study, and then on a weekly basis, 10 to 15 hours per week, you can maintain your own portfolio, but you have to do a meaningful diversification there. And the next thing I would like to clarify here, that set your expectations correctly. If you are here for the long term, then if you have to take a stock of your risk appetite, and according to that you have to arrange your portfolio. So from SD Capital perspective, if you are someone who is ready to take medium risk, then would suggest that set your expectation correctly, that 15 to 20% return is what you are after. Because in the world of investment, it is always about risk versus return. Higher the risk, your potential return is higher. Same story, it is your potential loss is also higher. So it's higher the risk, the volatility is higher. It can go up significantly, it can go down significantly. If you take medium risk, that's what we suggest for SD Capital clients. We always for Create Wealth customers, if it is medium risk, our target is 15 to 20% roughly speaking, but that is for longer term. And SD Capital only offer the service for a minimum of 2-year period, because we have emphasized in past for retail investors the intraday and swing and all that for very specific reasons. excuse me, they do not really work greatly. You can go back to different videos on our channel, and we have proven via mathematical models, via real proof, that it doesn't work. So if you are here, you need to be here for the long term. You have to be investor rather than a trader, and you can make real good money by meaningful diversification and being careful about the stocks you are investing in. So I know we are coming to an end, and at the beginning of the video today I didn't mention about the free stock recommendation. That doesn't mean that we are not going to provide a free stock recommendation. We always do, and today's free stock recommendation is Wipro. We do believe Wipro has a great bull run ahead of it. Once again, the stop loss price, the target price, all of those will be shared with our customers, SD Capital's customers. But if Wipro is something which suits your portfolio, we believe it is the right time to enter into Wipro, and you will be able to generate real good return from it in future. So all said and done, that's all for today really. We will meet again after 2 weeks in our next video. Thank you. Take care. Bye.